Hi traders, welcome back. In this video, we're diving deep into mastering the bias or direction of the market. I'll break this down into 6 key steps. Firstly, we'll discuss PD arrays, then candle science, order flow, second candle rejection, arguments, and finally, top-down analysis. Without further ado, let's get started. PD arrays. PD arrays stand for premium and discount arrays. These act as support and resistance zones that attract and repel price. Premium arrays are located above the current price. They attract price upwards and then push it down. Conversely, discount arrays are located below current price. They attract price downwards and then push it upwards. Price is always moving towards a PD array, and it's our job as traders to identify which PD array is next. Identifying the next PD array essentially means finding our target. Once we know our target, we automatically know the market's direction. Here are the main PD arrays I focus on: fair value gaps, swing points, and fair value areas. I previously mentioned order blocks as a PD array in past videos, but understanding fair value areas means you've also grasped order blocks, breaker blocks, and mitigation blocks automatically. Fair value gap. This is a 3-candle pattern where the first candle can form however it likes, either a consolidation or expansion. The second candle must be an expansion candle closing above the first candle's high for bullish fair value gap, or below the first candle's low for bearish fair value gap, creating a potential area for a gap. The third candle should leave this gap to confirm the fair value gap. Let's identify these in a chart. We are on the DXY chart, daily time frame. Let's begin by marking some fair value gaps clearly. First, notice this potential bearish fair value gap right here. Now, why do I call it potential? Because this third candle hasn't closed yet. It's still forming. However, if it closes just like this, it will officially become our bearish fair value gap. Now, let's examine this fair value gap down here. Initially, it was a very clean and valid bullish fair value gap. But remember this crucial rule. Once a fair value gap is traded into, or mitigated, it's no longer relevant for future price reactions. Yes, for educational purposes, it remains a valid example. But don't mistakenly expect price to react from it again. In fact, after a fair value gap is mitigated, the only area I'll look for a potential reaction is at the swing high or low created during that first reaction. For example, some traders might extend this fair value gap forward, assuming price reacted from it multiple times. However, that's not accurate in my view. What really happened here is this. Price initially traded into the gap, created a low as it attempted to move higher, then price retraced back down, swept that low, and finally moved higher. Another important tip when marking fair value gaps: always focus on the current price leg. For instance, at this point here, this bearish fair value gap was the only relevant one. Similarly, at this moment right here, this bullish fair value gap was the cleanest and most relevant. How do you identify the current price leg clearly? By marking your swing points. Now, before we move forward, let's quickly define what swing points actually are. Swing points. Swing points include swing highs and lows. Formed by a 3-candle pattern, the middle candle sticks out either at the top, for a swing high, or bottom, for a swing low. Let's mark these swing points clearly in the chart. We're back on the DXY daily chart. Now keep in mind, it doesn't mean these PD arrays can only be marked on daily timeframes. They work perfectly on all timeframes. Later in this video, after we've covered the concepts thoroughly, I'll also explain the best timeframe alignment for your analysis. Let's quickly identify some swing points clearly. First, we have this swing high right here. Why? Because the middle candle has a high that is higher than both candles around it, one candle to its left and one to its right. Same goes for this swing high here, and this one as well. Now let's mark some swing lows. We have this clear swing low right here. Here's a quick tip. I personally use swing points as targets for my trades. For example, right here, this swing low was my target before price traded into it. Applying what we've learned so far, our next target becomes very clear. It's this swing low down here. Why? Because this current price leg contains this potential bearish fair value gap, which aligns perfectly with targeting the next logical swing point. As we continue, you'll clearly see why I didn't select these previous swing highs as my targets. Fair value areas. These are market zones where both buyers and sellers were offered a fair chance to participate. A bullish fair value area forms when there's a movement upwards, buy side, a pullback downwards, sell side, then another movement upwards, buy side again. Marking from the high to the low creates the fair value area. We expect shallow retracements to offer fair value before continuing upward. The same logic applies inversely for bearish fair value areas. Let's see them on the charts. We're still on the DXY daily chart. Now let's identify some clear fair value areas. First, we have this bearish fair value area right here, currently pushing price lower. Why bearish? Because the market offered sell side first, allowing sellers a fair chance, then offered buy side, and again sell side. To clearly mark this zone, we start from this low to this high, giving us our bearish fair value area. Notice as price was moving downward from this area, it created additional bearish fair value areas, like this one here and another clear one here. Now, regarding this current fair value area, you might initially think it's unclear, but if we move to the 4-hour time frame, you'll quickly see how clean this fair value area actually is. Here's a quick tip. Sometimes you'll notice I mark these fair value areas from wicks, and other times from candle bodies. Here's the reason. If a wick overlaps a fair value gap, like this area here, it's valid to mark the fair value area from the wick. However, if there's no overlap, you should always mark from the candle bodies. Let's demonstrate clearly on the 4-hour time frame. Here, you'll see marking from the wick won't overlap with the fair value gap, so I mark from the body instead, like this. Same goes for this one here. Notice how precisely price reacts to these fair value areas. That's how you identify and properly mark fair value areas on your charts. Let's move on. Candle science. Candle science, or candlestick logic, involves reading a single candle to predict the next candle's direction. Once you've marked your PD arrays, candle science helps determine if the market respects or disrespects these areas. A respect candle has a long wick indicating rejection and signaling either a reversal or continuation in the opposite direction. Disrespect candles have strong body closures indicating continued momentum. Importantly, focus only on PD arrays, not random areas, to maintain accuracy. Let's demonstrate this clearly in the charts. Now let's move into the 4-hour time frame on the DXY to see candle science in action. Take a look at this candle here. This is a bearish respect candle, and you can tell by its long wick at the top. It respected this swing high right here, giving us an early signal that price was sweeping the high and preparing to reverse. We see the same thing again with this candle. It respected the fair value area to the left, again suggesting price was rejecting that zone. Now let's look at some disrespect candles. This one here is a bearish disrespect candle, showing a strong body close right through this bullish fair value gap, giving us the message that price wasn't offering a fair chance to buy. It was plowing through. Another example. This bullish disrespect candle right here completely ignores the nearby swing high, signaling strong bullish momentum. One thing to note, I only look for respect and disrespect candles at PD arrays. Don't go looking for them randomly across the chart. If you do, you'll lose accuracy, especially when money is on the line. Now, before we move on, there's one key principle I want to leave you with. Price is always doing one of two things, either offering fair value or seeking liquidity. When price respects a PD array, it's offering fair value, like we saw here on the daily, where this bearish fair value gap was respected. But when price disrespects a PD array like this swing low here, that's a clear sign that it's seeking liquidity. And where is that liquidity? Right here, at this next swing low. There's a lot more to cover when it comes to liquidity, but we'll save that for another video. Let's move on. Order flow. Order flow refers to consecutive movements, clearly indicating market intentions. Two types of price legs exist: high probability, with a fair value gap, and low probability without a fair value gap. An order flow leg is simply a high probability leg, containing a swing point, fair value gap, and fair value area. All three indicate strong market intentions. Order flow legs have 3 lines of defense. First line of defense, ideally a fair value gap, overlapping defense, ideally a fair value area, and last line of defense, always a swing point. We expect markets to react from these defenses. Although order flow is an extensive topic covered deeply in my mentorship, today's foundation will significantly improve your market bias. Let's illustrate this clearly on the charts. All right, let's go ahead and mark some order flow legs. Right here, we have our current bearish order flow leg, and here's how we know it's bearish. It's made up of 3 key components: a swing high, a bearish fair value area, and a bearish fair value gap. But here's where it gets even more interesting. This order flow leg actually forms from a previous order flow leg, this one right here. So what does that tell us? When you see consecutive bearish order flow legs forming, it's a strong indication that sellers are in control. It reinforces our bearish bias and increases confidence in targeting this low right here. Each leg confirms the intention of price to move lower. This is how we let the market show us who's in control. Let's keep going. Order flow and candle science are interconnected across time frames. A respect candle on higher time frames represents a failing order flow leg on lower time frames. For example, a bullish respect candle indicates a bearish leg flipped into a bullish leg. Second candle rejection. Second candle rejection originates from the idea that when price first touches a PD array, it should form a rejection or respect candle, and the next candle expands away from the PD array. Sometimes, the first touch doesn't form a respect candle. That's when the second candle rejection becomes valuable. Second candle rejection happens when the second candle immediately rejects the movement of the first candle, clearly showing market intentions. Simply put, if the first candle fails to reject the PD array, look for the second candle to sweep past the first candle's movement before continuing. Understanding second candle rejection clarifies whether a PD array is holding or failing. Let's examine this concept in chart examples. To clearly illustrate the second candle rejection concept, let's move up to the weekly time frame. Of course, this setup can appear on any time frame, but in this case, it's most visible here. Now take a look at this point where price is mitigating this bearish fair value gap. The first candle closes inside the gap, so at that moment, we're waiting for confirmation. And what does the second candle do? It sweeps the high of the first candle and immediately rejects. That's our second candle rejection in action, and that gave me full confidence that the fair value gap was holding and we could expect price to move lower. Same logic applies here. We had a bullish fair value gap. The first candle closes inside the zone, and the second candle sweeps the low before reversing. That sweep and rejection signaled strength, and it confirmed our bullish bias going forward. And it doesn't stop there. You can also spot second candle rejection setups on swing points too. The key takeaway? Second candle rejection helps validate whether your bias is still holding or starting to shift. And that makes it a powerful tool in your directional analysis. After understanding these concepts, you might have conflicting market arguments. A strong market bias results from weighing bullish versus bearish arguments. Identify potential PD arrays and use candle science, order flow, and second candle rejection to assess strength. If bearish arguments strongly outweigh bullish ones, prioritize a bearish bias. Conversely, if bullish arguments dominate, prioritize a bullish bias. Let's explore this clearly in charts. Now we're back on the DXY daily chart, and I want to walk you through how I handled a moment of conflicting arguments before the bearish bias became obvious. First, if you've watched my weekly forecast videos, you'll remember something I always say. I don't marry biases. I stay open and adapt to what the market is communicating. That's key. But I don't flip from bullish to bearish instantly. Instead, I move in phases. Bullish to neutral, or 50-50, to bearish, or vice versa. That's how I personally believe the market transitions too. Gradually, not instantly. Now let's break this price action down. We were clearly in an uptrend, forming clean bullish order flow legs. Then we tapped into this bearish fair value area and price started rejecting. Did I flip bearish immediately? No, I didn't. Instead, I reviewed my arguments. Bullish argument. This bullish fair value gap below. Bearish argument. The rejection from this fair value area above. So right there, I'm in a 50-50 zone. Neither bias is dominant yet. To break the tie, I waited for confirmation. A close above this swing high would cancel my bearish argument, giving me a clear bullish bias. A close below this swing low would cancel my bullish argument, confirming a bearish bias. And as we can see, this candle closed below the low. All arguments now point bearish. That's how you manage bias with logic, not emotion. Top-down analysis is a structured approach from higher to lower timeframes, ensuring trading clarity. Bias should ideally come from higher timeframes, monthly, weekly, or daily, as larger market participants focus there. For day traders and scalpers like me, even 4-hour charts are useful when we are looking for the market bias. Your analysis should follow this structure. Bias. Here, you will analyze overall market direction. Narrative. Identify the PD array that price will react from, and entry. You will use your preferred entry pattern to get involved. Here's the time frame alignment I use. Remember, we've only covered market direction or bias here. There's much more detail available in my mentorship program. If interested, you'll find the link in the description. Mastering market bias using these concepts simplifies trading decisions, enhancing accuracy and consistency. Apply these steps regularly, and you'll see significant improvements. Thanks for watching. If you found value, please like, subscribe, and comment your questions below. Happy trading!